In the last 48 hours, the world changed forever. Right now, gold is trading around $5,256. Silver is at $95. But here is what they are not telling you on mainstream financial news. On March 1st, 2026, President Donald J. Trump authorized Operation Epic Fury, a precise, overwhelming military campaign to eliminate the imminent nuclear threat posed by the Iranian regime, destroy its ballistic missile arsenal, degrade its proxy terror networks, and cripple its naval forces. U.S. and Israeli strikes hammered Iran over the weekend, killing Supreme Leader Ayatollah Ali Khamenei. Gold hit intraday highs near $5,120 per ounce. Silver jumped to $96 before pulling back sharply. The war premium is building fast, and what I am about to show you is why gold at $5,650 and silver at $98 may be just the beginning. Analysts are now forecasting potential targets of $5,500, $6,000 per ounce if hostilities intensify further. If you own gold or silver, you need to understand what just happened. If you are thinking about buying, you need to understand why this war could send precious metals to levels nobody thought possible. Something massive just unfolded, and by the end of this video, you will understand exactly what it means for your wealth. Welcome to AG Profit Hub. This is where we cut through the noise and expose what is really happening in precious metals markets while everyone else feeds you the official narrative. Subscribe right now and hit that notification bell because this situation is evolving by the hour. If you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see the truth. And trust me, what I am about to reveal is something the mainstream financial media is not connecting for you. Let me walk you through exactly what happened in the last 48 hours, because the speed of these events is staggering. President Trump outlined his administration's justification for going to war against Iran alongside Israel, saying that Iran posed grave threats to the U.S., even as he again claimed that U.S. strikes on Iran in June of last year led to the obliteration of Iran's nuclear program. U.S. and Israeli forces hit over 2,000 targets inside Iran: missile sites, Navy bases, and the Natanz nuclear facility. The Iranian Red Crescent reports over 555 dead. Trump added that the military had originally projected 4 weeks to terminate the military leadership of Iran. To date, Iran's Supreme Leader Ali Khamenei and several other top officials, including the head of Iran's Islamic Revolutionary Guard Corps, have been confirmed killed in U.S.-Israeli strikes. "We're ahead of schedule there by a lot," Trump said. But here is the part that should have every precious metals investor paying attention. The Iran conflict entered its 4th day as explosions rocked Tehran and Beirut, while a senior Iranian Revolutionary Guards official said on Monday the Strait of Hormuz had been closed. The U.S.-Israel military operation, Khamenei's death, Iranian ballistic missiles striking Dubai, and the Strait of Hormuz shutting down sent investors flooding into precious metals, the Strait of Hormuz. 20% of the world's oil supply flows through that choke point. When it closes, everything changes. Gold price moved above $5,400 as the Iran-Israel conflict escalated, triggering a sharp repricing of geopolitical risk. Brent crude jumped 13% toward $82 on Strait of Hormuz fears, reinforcing inflation concerns. Oil spiking, inflation fears returning, and gold and silver responding exactly as they have for 5,000 years. Now let me explain exactly what a war premium is and why it matters, because most people do not understand this, and that misunderstanding could cost them a fortune. Comprehensive analysis across decades of conflicts demonstrates that gold consistently serves as the primary crisis hedge, averaging 0.30% gains in the first week of major conflicts and an impressive 8.98% over 12 months. This pattern has repeated across diverse geopolitical events, from regional conflicts to world wars, establishing gold's reliability as a portfolio stabilizer during turbulent times. 8.98% over 12 months. That is the average. But this is not an average conflict. Historically, such spikes have occurred during periods of intense stagflation or global conflict, most notably during the oil shocks of the 1970s. However, the 2026 rally is unique in its scale. reflecting a modern financial system that is far more interconnected and susceptible to rapid capital flight than in decades past. And here is what the smart money is doing right now. CFTC data shows that money managers have significantly increased net long positions, while commercial hedgers have reduced short exposure. This positioning shift suggests confidence in continued upside for gold prices rather than purely defensive positioning. 12 institutional flows reinforce this narrative. GLD and IAU have recorded their largest net inflows in 18 months, supporting continued upside in gold prices. The institutions are not hedging defensively. They are positioning for a sustained move higher. JP Morgan analysts flagged a 5 to 10% risk premium jump even before today's moves and still eye 6,300 plus longer term. $6,300 from JP Morgan. And that was before the Strait of Hormuz closed. Now let me show you exactly how gold is responding because the numbers are extraordinary. The immediate catalyst for gold's historic breakout came on February 28, 2026, when coordinated U.S. and Israeli strikes on Iranian targets triggered panic buying across precious metals markets. Gold futures surged over 2% in a single session, pushing prices from approximately $5,100 to over $5,300 per ounce. On Monday, the price of gold surged past $5,400 per ounce after U.S. and Israeli forces conducted joint military operations. Spot gold prices surged to an unprecedented level, while gold futures on the COMEX breached the $5,400 mark, representing a historic decoupling from traditional price ceilings. But here is what the chart analysts are projecting. If the conflict expands and energy disruptions intensify, gold could extend toward the 5,500 to 6,000 range. In such a scenario, safe haven allocation, inflation hedging, and institutional flows would reinforce each other. Volatility would remain elevated, but the directional bias would stay upward. Since the gold price has broken $5,090, prices are now looking toward $5,600 as the immediate resistance. However, the escalating geopolitical crisis will likely push above $5,600 and open the door towards $6,500. $6,500 gold. That is a 25% increase from current levels, and some analysts see even higher. In the short term, analysts from major investment banks have already begun revising their targets, with some suggesting gold could reach $6,000 by year-end if the Strait of Hormuz remains closed. And here is the fundamental reality that supports these projections. Even before the U.S.-Iran military escalation, gold markets were experiencing a powerful bull run that had already delivered approximately 22% gains year-to-date. The precious metal had benefited from a confluence of favorable factors including persistent inflation concerns, central bank buying, currency debasement fears, and ongoing geopolitical tensions. This pre-existing bullish setup meant that gold was primed for explosive gains when the conflict triggered a safe haven stampede. Gold was already in a structural bull market. The war just poured gasoline on the fire. Now let me show you what happened to silver because this is where the real volatility is playing out. Silver jumped to $96 before pulling back sharply. Silver fell to $83.70 per ounce on Tuesday, March 3, 2026, down another 7% on the day after losing nearly 5% on Monday, wiping out the entire safe haven premium built on the back of the U.S.-Israel strikes on Iran and the closure of the Strait of Hormuz. From Monday's opening spike above $96, the metal has now shed roughly 13% in just 48 hours. 13% in 48 hours. That is silver. That is what it does. But here's the critical insight. Gold, by contrast, closed Monday up 1% and is falling just 1.3% on Tuesday, trading near 5,250 SACs. Silver, as it has repeatedly demonstrated throughout 2026, is playing an entirely different, far more violent game. But does this correction mean the rally is over? Absolutely not. Analyst forecasts of $150 silver in 2026 appear increasingly plausible given the convergence of wartime safe haven flows, structural supply deficits, and accelerating industrial demand. Silver's smaller market size relative to gold amplifies price responses to demand increases. The strong volatility in the precious metals market and the increase in safe haven demand indicate that the silver price will likely break $120 in 2026 and move towards $150. The short-term price action for silver also shows strong bullish price action. $120 to $150. That is what the technical analysts are projecting. Analysts who expect silver to reach $100 or higher in 2026 often cite the gold-silver ratio compression as a key driver. If gold achieves forecast levels of $5,500 to $6,000 and the ratio compresses toward historical norms of 50.1 or lower, silver prices would necessarily rise well above $100 per ounce. Let me do the math for you. Gold at $6,000 with a 50.1 ratio equals $120 silver. Gold at $6,500 with a 45.1 ratio equals $144 silver. The math works. The only question is timing. Silver has outperformed gold, breaking above the psychologically important $90 level and reaching approximately $94.59. When silver accelerates faster than gold, it typically signals broader speculative participation rather than pure defensive hedging. The silver-to-gold ratio has narrowed slightly, suggesting that investors are not only seeking protection, but also positioning for a sustained metals uptrend. Now let me show you why the oil spike matters for precious metals, because this is the connection that most people miss. Crude oil benchmarks jumped over 8% on Tuesday in response. Damage to energy infrastructure and stalled tanker traffic through Hormuz have lifted the risk of sustained strength in oil, gas, and refined products, stoking inflation fears and pushing back rate cut expectations. Oil soared the most in 4 years. When oil spikes, inflation follows. When inflation accelerates, gold and silver become essential hedges. Central banks now face a harrowing dilemma. Inflation is likely to spike due to rising energy costs, but raising interest rates into a geopolitical crisis could trigger a deep recession. This trapped position for policymakers only adds fuel to the gold rally, as investors lose confidence in the ability of fiat-based monetary policy to manage the dual shocks of war and inflation. The central banks are trapped. They cannot raise rates into a war without causing a recession. They cannot ignore inflation without causing currency debasement. Gold wins either way. Much of the premium associated with ongoing geopolitical tensions is already priced in for oil. Gold remains our most preferred hedge, a disciplined diversifier that tends to extend its performance during oil shock. That is Societe Generale telling you exactly how to position. And here is the historical precedent that should concern everyone. Prices are set to rise by around 42% in 2025. Marking the strongest annual gain since the late 1970s. Both the 1979-80 surge and the current rally have occurred alongside heightened geopolitical tensions and a weakening U.S. dollar. The 1970s, the last time we had an oil shock combined with geopolitical crisis. Gold went from $35 to $850, an increase of over 2,300%. Now let me tell you what the analysts are projecting for the weeks ahead, because this is critical for your positioning. Trump said the plan for the Iran war initially projected 4 to 5 weeks, adding the U.S. military has the capability to go far longer than that. If Trump's 4 to 5 week timeline holds and Iran's regime cracks without closing Hormuz for good, we could see a sharp pullback. But the structural bull case, de-dollarization, central bank buying, and endless deficits stay intact. This war just accelerated it. Conversely, a credible de-escalation involving reopened shipping lanes and diplomatic progress could trigger a sharp correction. So there are 2 scenarios. Let me break them down. Scenario 1, rapid resolution. If the war ends quickly and the Strait of Hormuz reopens, we could see a pullback. If there's a sudden peace agreement or a truce, the war premium could disappear quickly and prices could fall back to around $5,000, according to Bloomberg. Scenario 2, prolonged conflict. The U.S.-Iran war introduces additional upside potential beyond baseline forecasts. If the conflict escalates or persists, driving sustained safe haven demand for precious metals, silver could achieve the more aggressive price targets of 100+ earlier than anticipated. And here is the wild card that nobody is discussing. A February 18, 2026, analysis in Axios said that there were no signs of a breakthrough in negotiations, making war look the most likely option. The negotiations failed. The war is here, and the path to de-escalation is unclear. The reality is, that even an ostensibly limited U.S. military strike runs a serious risk of unleashing an Iranian counterattack and prolonged regional conflict. Now let me tell you what this means for you, because understanding the situation is useless if you do not know how to act on it. The investment implications extend far beyond simple price appreciation. Portfolio allocation to gold has become a critical risk management tool in an increasingly unstable geopolitical environment. Financial advisors commonly recommend 5 to 15% allocation to precious metals, but the current conflict has prompted many strategists to advocate for higher allocations, particularly for investors concerned about systemic risks, currency debasement, and the potential for broader Middle East escalation. If you are holding physical gold and silver, understand what you have. You are holding the ultimate insurance against exactly what is happening right now. The consistency of gold's wartime performance stems from deep structural characteristics that remain relevant regardless of the specific conflict. Gold has no counterparty risk, cannot be devalued by government decree, and maintains purchasing power across centuries. When missiles fly and nations clash, these characteristics become invaluable to investors seeking to preserve wealth through uncertain times. If you are looking to buy, understand the volatility you face. Tai Wong, independent trader, says any sell-off on the fact will find buyers fast. I think gold and silver could sell off on the fact on the open, but any significant sell-off will find buyers because the picture in Iran won't be clear until weeks or months. Pullbacks are buying opportunities for those with a longer time horizon. The fundamental case for precious metals has only strengthened. Beyond the immediate safe haven demand triggered by the U.S.-Iran war, silver benefits from strong fundamental tailwinds that create a supportive backdrop for sustained price appreciation. These structural factors distinguish the current environment from previous crisis periods and may enable silver to maintain elevated prices even if geopolitical tensions eventually resolve. Let me leave you with this. The events of March 2, 2026 will likely be remembered as a watershed moment for the global economy. The breach of $5,400 in the gold futures market is a clear signal that the world's perception of risk has fundamentally changed. Driven by an explosive cocktail of Middle Eastern conflict, central bank diversification, and energy supply shocks, gold has reasserted its role as the premier global safe haven. Operation Epic Fury launched on February 28th. Ayatollah Khamenei is dead. The Strait of Hormuz is disrupted. Oil is spiking. Inflation fears are returning. Gold hit $5,120. Silver hit $96. With Washington amassing its biggest military deployment in the Middle East since the Iraq War in 2003, bullion posted its 7th consecutive monthly gain in February, the longest streak since 1973, the longest winning streak since 1973. The year before the last great precious metals bull market began, gold's bull market remains intact despite volatility, with record highs driven by global uncertainty. Inflation, de-dollarization, and central bank demand are structurally supporting gold prices. The war premium is building, the structural drivers remain intact, and the world just got a lot more uncertain. Risks to the precious metals outlook are tilted to the upside. Renewed geopolitical tensions, trade frictions, or financial market volatility could prompt additional safe haven demand, pushing gold and silver prices above current projections. Gold, $5,750. Silver, $98. Those are not fantasy targets. They are what the war premium plus structural fundamentals suggest. The question is not whether precious metals will respond to this crisis. They already are. The question is whether you are positioned. Drop a comment telling me whether you think this war resolves quickly or escalates further. I read every single comment. Subscribe if you have not already. Hit that notification bell because this story is evolving by the hour and you do not want to miss what comes next. The 48-hour deadline passed. The war began. The war premium is building fast. And now you understand why. This is AG Profit Hub because the real story is never on the surface. I will see you in the next one.